Okay, good afternoon, actually, everybody. I'm the chair of this session. Welcome, everybody. My name is Fang. I work at the macro financial department of Central Bank of Ireland. And today we have three very interesting papers about firms, performance, survivability, and during the COVID crisis. And we start with, sorry, I have to bring up the program. Yeah, we start with Epaulard, and she will present the paper will Schumpeter caught COVID. So I'm really interested in the paper because the title is so catchy. So go ahead, you have 20 minutes to present.
Thank you very much, Fang, and hello to everyone. Welcome to this session. I'm going to try to share my screen. This is it. No, this is not it. I'm sorry. Can you see my screen or not? I'm sorry.
Not yet, but it's showing it's starting.
Is it showing or not?
I couldn't see just yet.
Not yet.
It's showing is sharing. I guess it's just coming up slow.
That's very strange because I tried to share it earlier. I'm going to try again.
Yeah, I would try stopping your share and resharing.
Okay. Can you see or not?
Yeah, now we can see.
There it is.
Okay, and I have to go to the first slide and make it bigger. I'm sorry for that. Okay. One more thing. Oops. Okay, I'm afraid I can do better because there is something. Okay. Here it is. Okay. So I'm going to present you this paper, which is Will Schumpeter Catch COVID-19? And it's a joint paper with Mathieu, Cros, who I just think is among the people listening to this seminar, and together with me with Paris Dauphine and France Strategy, and Philippe Martin, who is with Sciences Po Paris and CEBRA. And thank you for the organizer to having me for this very interesting session to which I was looking forward to. Okay, so this is my first slide, and maybe it takes some time to look at it. But so what we've done here, if we took from official sources all the bankruptcy filing by funds in France every single year since 2008. And if you look at so this is by weeks. And so you see that in 2019, this is the red line. In 2019, at the end of the year, 2019, we had something like 38,000 firms filing from bankruptcy, either the equivalent of Chapter 11 or Chapter 7. If we look at the same number for 2020, we see that it is much, much below. We have less than 25,000 bankruptcy filing in France over the year. And same thing is happening now in 2021. After 19 weeks, we were still much below what we used to be either in 2019 or the previous years. The blue line is showing you the average over the period 2008-2019. So we have a big drop in bankruptcies in France since the start of the pandemic. And you see that before the pandemic, basically, this is mid-March, the moment where the the economy was stopped, we were more or less on the same on the same path as the previous years. So we are fully confident that what we see here is the consequence of the pandemic. Well, not only the pandemic, of course, but the pandemic and the measures that were taken by government to try to keep businesses and households alive. So what we see on this graph happened in France, but not just in France, okay? In France, it was more or less minus 36% of bankruptcy filings. And it was not what was expected at the beginning of the pandemic. I don't know whether you know this paper by Pierre-Olivier Gourin-Chasse, but he has this very paper in which he simulates for many countries the number of bankruptcy that had to be expected if the economy was to be more or less shut down as it was. And the result of this simulation were dramatic in the sense that what we were expecting was an increase in the number of bankruptcy filings. Of course, this is not what happened, okay? And the reason why is that there have been huge government policies to try to prevent households to lose their incomes and revenue to exit the market because of no sales or no liquidity or any other issue. So in France, there was, and as in many European countries and also in the United States, the government put in place some policy to channel liquidity to firms, either by grants or by or to help them borrow from banks with a guarantee by the government on these loans. There was also some deferred payments of social security contribution and tax charges, direct transfer to small firms just to help to make them afloat, and also lower cost with the part-time measure that allow companies to recover part of the wages they were paying while their employees were not working. The question is it, so we have all this policy. As a result, we saw that we have much less bankruptcy compared to previous year. And so the natural question is, did government go too far? Or did it do the policy for too long? And is there a risk of zombification, which is more and more companies that are not viable and they are just here in the economy and they prevent other firms to grow faster? Okay, so that's the policy debate. And our paper is going to try to give some illustration and to try to discuss this issue. At the beginning of the pandemic, there were two different risks concerning firms. The first one, which is what we call the zombification of the economy, is the possibility that because of all this liquidity that is channeled to the firms, firms with very low productivity, instead of exiting, are going to survive and are going to cloud a little bit the functioning of the economy. In the past, for example, Banerjee and Hoffman, they show that this rise in COVID was there even before the pandemic. And I think we are going to see the paper by Angela right after mine, which makes also this point. Also, we have the information that it is likely that the exit of firms is a major source of productivity growth, because usually firms with low productivity are the ones that are exiting the market, so which is and as a result, it helps productivity growth. The second risk we had at the beginning of the pandemic was kind of the opposite risk. It was, what if, because of liquidity shortages or because of impossible to stay open, some firms, high productive ones, were going to be forced out of the market, even though in a normal year, they would have been very productive. Okay? So COVID COVID-19 because it triggered the close of the economy, could have resulted in many firms that became insolvent while they were viable on the longer run. And we know from previous work that firm failure does not only depend on their productivity, but also on access to credit. This is a famous paper by Gadi Barleby. And also, we know that in France, apparently during the previous recession, the selection into exit was less efficient than in normal times. Okay. So basically, we had two risks: the survival of low productivity firms and the exit of very high productivity firms. So in this paper, we are providing some early and preliminary evidence that in the COVID crisis, okay, there is no evidence of major distortion in the selection process of firms toward exit. First thing we are going to show. The second thing we are going to show is that the COVID shock that was experienced by firm was almost fully compensated by government policy. So these two things are telling us that, of course, there was less and less firms that were going bankrupt, okay? But, okay, we're going to see what that was like, and that the government did quite a good job, okay? And then the second part of the paper, I'm not sure I will have time to go to that, is that if we try to model what is going to happen next, okay, we are going to have an increase in the number of bankruptcy, but that increase in bankruptcy is going to be mostly the result of catching up from these bankruptcies that didn't happen in 2020 and early 2021. This firm, at the end of the day, they have to exit, otherwise we have the problem of zombification. Okay. But for some of them, we are going to have the question of corporate debt. Okay. Okay, so next. So I'm going to come up with some data and descriptive statistics, then I will show you some empirical results, and if I have time, we will go to the scenario for the future. Okay, so we have all this information starting in 2013 to 2020, and now even 21. We have daily electronic files that report all bankruptcy filing in France. We merged that with information regarding the sector of the economy, its location, and also its income statement and balance sheet. Okay. So we have a lot of information about this firm, including where they are, how big they are, and all their income statement and financial situation. Then we restrict, there is a typo here, we restrict to a sample of firms that have more than one employee and less than 250. Together, it's in the year 2020, we have more than 1 million firms. And in 2013, we have slightly less, but we can follow the firm over the period. And what we do, we look at the balance sheet of one given firm that becomes bankrupt, that files from bankruptcy in 1 year. What was income statement and balance sheet information 2 years before? The reason we have this 2-year lag is that usually when a firm goes bankrupt in year T, then it is likely that we're not going to have the income statement for the year T-1. That's why we use T-2. Okay, and then I like this graph very well, very much. Okay, so I'm going to spend some time explaining it. We are looking at the labor productivity of firms in our sample. And in the blue line is the labor productivity of firms, okay, that in 2018 that don't go bankrupt, neither in 2019 nor in 2020. In red, okay, we have the labor productivity of firms that went bankrupt in 2019. And in the small, we barely see them in black. we see the labor productivity of firms that went bankrupt in 2020. And what we see here is that basically we don't see any distortion. We don't see that the distribution of labor productivity of firms becoming bankrupt in 2020 is moving towards the right, as would have been the case if some good firms would have been kicked out of the market because of the pandemic. So this is not happening. Same thing if I look at the debt ratio, at the leverage ratio of these firms that are exiting, okay? Again, the blue distribution is the one of firms that stay in the market, and the red and black distribution are the one of firms that exit the market in 2019 for the red the red histogram, the distribution, and in 2020 for the black one. And we see exactly the same pattern. Firms with high debt, high leverage are more likely to exit the market to become bankrupt in 2019 and in 2020, exactly in the same way as for the 2 years. Okay. So basically, we are confident, and I'm going to show you some econometric results that that our main conclusion. We can see that apparently from these two graphs, that firms that are exiting the market are more or less as bad as the one that exited in 2019.
Sorry, you have 5 more minutes.
Okay, to try to make that more clear, we are going to have some estimate a model, a logic estimation, in which we try to predict the bankruptcy filing by a given firm with its labor productivity, its debt, the number of its employees, the age of the firm, and the sector fixed effect. And we want to confirm what we saw in the 2 previous slides. And this is basically what you see. If you look at 2019, 2020, the last 2 columns in this table, but also the previous line, the previous column, you see that what predicts bankruptcy is always the same variables. They are all very significant, and the thing that moves the most is the constant, okay, the intercept. But for the rest, coefficients are very, very similar from one to each other. Okay, so from that, our main result is that there is no drastic change in 2020 when it goes to the determinant of bankruptcy. So the second risk we were afraid of, that good firm will exit the market, didn't materialize. Okay. Again, in 2020, as in 2019, what predicts bankruptcy is low productivity, high debt, the size of the firm. Next, we want to see if we can measure how effective the policies were in preventing firms that were especially hit by the COVID shock to protect them from going bankrupt. So what we do, so we know that some sectors were more affected by the COVID pandemic than the other. For example, restaurants were closed, and funerals, they enjoy a boom, unfortunately. Okay. There was a lot of support measures, and there was some state guarantee loans that were not sector specific, and any firm could apply to this one. The question we want to answer is how much these policies help absorb this the shock. So we are going to focus on retail sectors with a very large understanding. Funeral service, we consider this is retail. Hairdresser, this is retail, and things like that. So it's a larger definition of retail than usual. Okay, and we use data from Groupement Carte Bancaire, which is the provider of credit card to people in France. And for each firms, no, for each very finely defined sector, we know the amount of credit card payments that were done during the first period where the economy was almost closed. And we can measure at a very fine sectoral level that some sector did very bad because they were badly hit by the shock. This is, for example, travel agencies. They saw their sales reduced by more than 60%, while other sectors were doing quite well, like tobacco shops, bakeries, funeral services. Okay. By the way, funeral services, their sales went up by 17%, but the increase in people needing these services went up by only 9%. So I think something happened with the price as well. Okay, so what we do here, so we take the company that are in this very large sector that deal with the public and that receive a lot of credit card payments. So it restricts a little bit our sample. We went from 1 million to slightly less than 400, okay? And we estimate exactly the same model. And here I reported the result only for 2019 to 2020. So what I want to do is that, and then, so the first three columns are exactly the same estimation as before. And in the fourth column, we add to the explanatory variable the sectoral COVID shock that we measure by credit card payment receipts. And we saw that indeed, the bigger shock you had, negative bigger shock you have, okay, because if you have a big number, it means the COVID shock was great, was large, okay. It increased the probability you are going to go bankrupt, okay. So that means that government policy didn't completely prevent those badly hit by the shock to go bankrupt. Okay. What we see, what is interesting, is that the rest of the coefficient barely move. Okay, and also we saw that there is a slight increase in the pseudo R2, but it is small. Okay. I'm going to.
Sorry, you have to conclude.
I'm going to conclude in 1 minute. Okay.
Yeah,
so what we say that the COVID shock is a significant predictor of bankruptcies, which means that support measure did not fully absorb the sectoral heterogeneity of COVID. Okay. However, when we add the COVID shock, we barely increase the model accuracy measured by the pseudo R square. And if I give you, and it will be my final slide, okay, if I look at what are in 2020, what explain the probability to go bankrupt is the debt, labor productivity, bank debt, the size of the firm, and the shock, the COVID shock measured by the credit card receipt is not a very good predictor. So it is significant, but it does not predict a lot. It does not add a lot to the prediction of failure. So from that, we conclude that government policy were quite efficient at helping, we think, prevent bankruptcy, even in the most affected sectors. Thank you very much, and sorry for having been so long.
Thanks, Anna. And the discussant is Federico Huneeus from Central Bank of Chile.
So I'm going to stop sharing mine.
Please.
Great. Okay, thanks for the organizers for having me discuss this great paper. Thanks, Anne, for the great talk. So I'm going to discuss this paper on Schumpeterian behavior during COVID. And, given my affiliation to the bank, the usual disclaimer applies. So I'm going to talk first about the normative versus positive implications of the analysis. I'll say something about dynamism concerns, measurement error concerns, and some empirical design issues and suggestions that I have, and then I'm going to do some final remarks. So first, in terms of the normative versus positive implication, the goal of the paper is sort of to understand whether policy support or what happened during the crisis distorted bankruptcy behavior. So on the one hand, you have this excessively large support to firms that could dampen creative destruction forces and sort of create some problems related to zombification. And then on the other hand, excessively small support could imply too much destruction, even of ex-ante productive and viable firms. So then the key policy question is the trade-off between sort of the magnitude that you give to each firm, the speed of how fast that money gets to firms, and also the scope, sort of the coverage of support that you give to firms. And this in turn obviously maps to evolution of aggregate productivity and the recovery. So these are super important questions, and the paper sort of tackling a key discussion that we've been seeing in the last couple of years. And the authors find the result that creative destruction has been partially frozen but not distorted. So then sort of, there's a fundamental normative aspect of both the question and also the answer. And so then the natural response is, which is the counterfactual? Should bankruptcy behavior not have changed during the crisis? Should it be the same that it would have been in a normal year? Is unchanged creative destruction bad because in recessions it should be more prevalent? So for example, you can have a conjecture that during recessions creative destruction forces might be stronger than in normal times, and therefore if you don't see anything changing during a recession in terms of behavior or sort of selection into bankruptcy, then maybe that would be something bad. But at the end of the day, whether it's good or bad that the selection into bankruptcy changed or didn't is a normative question. And in order to evaluate that, we need to have a counterfactual of what would have happened without sort of this policies, but also in particular the different shocks that firms faced. So I think this is sort of a problem or a challenge in terms of internal validity, in terms of how you can take these results and say something about whether what happened was good or not, or in particular this wording of whether it was distorted or not the process of creative destruction during this crisis. So this is obviously always a challenge from going from positive to normative analysis, especially if you don't have a model to sort of discipline that sort of step. But I think this is sort of a key part of the paper to sort of argue and convince the reader that actually the fact that creative destruction forces didn't change during the COVID crisis is an indication. That selection into bankruptcy didn't change during the COVID crisis is an indication that creative destruction forces worked the way they should have worked. So then one sort of small suggestion would be to look at another crisis to study bankruptcy behavior. I know that maybe you don't have the Great Recession crisis, but maybe there's one sector specific crisis happening during the years that you have. It would be sort of nice to show some bankruptcy behavior, some selection into bankruptcy during that particular crisis, even if it's not an aggregate crisis, to sort of show whether selection into bankruptcy changed during the crisis relative to normal times. I think that would be informative and would help sort of connect with this discussion of how we can sort of which is the correct counterfactual and how we can map the positive results to normative answers. That's my first comment. Then in terms of dynamism, obviously, I mean, this is something that you discuss in the paper, but I want to highlight it here. Might be that, the bankruptcy filing in the short-term behavior does not capture the overall bankruptcy filing relative to this event. So what if firms not just froze the bankruptcy, but will catch up later in a way that would be different to how firms file for bankruptcy in normal times? So this sort of connects with the previous comment in terms of understanding how the catch-up, the selection into bankruptcy of the catch-up period, it will be different or not relative to how it was in the sort of short term. So moreover, the later catch-up could be more distorted than bankruptcy behavior during 2020, and it will be sort of interesting to look at that. So at the end of the day, I think it would be good to evaluate overall the medium run, say after 2 years or something like that, the medium run selection into bankruptcy by taking into account also the selection during the catch-up phase. So I think that's sort of interesting. It would be nice to sort of put that together maybe at the end of this year, something like that. And kind of related to that, it would be interesting to look at higher frequency data to anticipate some of these patterns. So in particular, you know, if you look at sort of monthly selection into bankruptcy, that will sort of indicate to you how bankruptcy selection evolved in the worst part of the crisis, say mid-2020, relative to say mid-2021. So I think sort of looking at higher frequency data would tell you something about the dynamics of how selection of bankruptcy evolves during the crisis. The third comment is about measurement error. So obviously there's an issue, at least from the perspective of the data I've worked with, there's an issue of how representative bankruptcy filings are relative to actual firm exit. So this is an external validity challenge. In Chile, for example, the bankruptcy behavior is only taken as a last resort. So you usually see a very small set of firms that end up going into that sort of legal process. And it usually involves relatively large firms with complex net worth composition. So this sort of may limit the scope of this data and this analysis for studying small and medium enterprises because these firms actually, many of them don't go into that process. They just exit, and then maybe the owner is gonna go into some restructuring, but not like legally going into bankruptcy. As it works, at least in Chile. So there's some details there that I don't know how it works in France and in the EU, but this is sort of an issue that could be sort of affecting the results. And also, given the transitory nature of the shock, exit might be underestimated with the bankruptcy data. So in normal times, you have this issue of how bankruptcy represents actual firm exit, but then in a recession, that issue might be even more of a concern. And then on the other hand, could the authors measure something about entry of firms? So obviously at the beginning, there were these comments about discussions about, you know, entry and exit and how that affects productivity. It would be nice to understand how entry evolved during this crisis and where selection into entry changed relative to previous years. And in particular, also the role of transitory exit and re-entry. This is something that we've shown in Chile that was a big deal in 2020, especially given these policies that were sort of aimed at freezing activity and then reactivating again after sort of the worst part of the crisis was over. So if policies favored entry, could that also help productivity, and by how much? So I think complementing exit behavior with these bankruptcy filings with entry is important to fully gauge the Schumpeterian forces that the authors are interested in. So let me show you just a couple of moments from the data in Chile. So this is the number of firms in Chile. We've been involved in the bank. We've been sort of monitoring all of this over this year, over this last couple of years, using, you know, rich microdata, administrative microdata. So here you can see that, you know, the number of firms sort of dropped massively in 2020. Sort of it almost represents like 5 years of increasing number of firms. But then, you know, you see the V shape, right? It recovers super fast. So there's a lot of exit of firms, but then a lot of entry of new firms. Sort of that's why I'm saying that sort of capturing also the re-entry and entry of firms is kind of important to understand how Schumpeterian forces are working during this crisis. But, you know, in the data in Chile, you don't see such a large movement in bankruptcy filings. So in that sense, I'm sort of saying, you know, trying to look for alternative sources of data to think about exit of firms might be useful, especially for small and medium enterprises. And this is also something we did in the bank. So we sort of correlated. The left-hand side is a dummy of whether the firm reports or not tax information, which is sort of a measure of whether the firm is active. And you can see here, sorry that this is in Spanish. I had to take this from the monetary policy report in Chile, which is in Spanish. But here on the left-hand side, we have this dummy of whether the firm reports selling something domestically. On the right-hand side, we project that on a set of variables, but in particular, the growth of debt during the same period. So I think this is actually lagged a couple of months. So you can see here that as the firm received more debt, the likelihood of non-reporting went down. And this is sort of one type of analysis we've been doing of how selection into exit is correlated with some policy measures, because there was a big policy, a public credit guarantee policy that I'm going to discuss in my presentation that affected the growth of debt significantly in Chile. So this is something to say, you know, if you look at a different measure of exit, you can correlate that directly with some variables that you can see that evolve over this period. And it would be nice to kind of do this type of analysis that sort of extends a bit more the bankruptcy analysis to understand Schumpeterian forces. So just some final things in terms of empirical designs. I was puzzled by this fact that the COVID shock is defined at the industry level, but you have an industry fixed effect in the regression. So I'm not sure what was going on there. Maybe because you use a narrower industry classification for the COVID shock, that was a bit unclear. Then the second thing is that you could add location fixed effects, given that many health policies were also targeted geographically. So I think that would be nice to kind of understand how relevant that is. And also add firms with no debt. So unbanked firms to the analysis. So you're controlling for debt to asset, but that sort of limits the set of firms that you can study. It would be nice to sort of extend that. In Chile, I'm going to show you later, these firms behave differently to relative to bank firms. I sort of dig a bit more into why the R-square is lower in 2020. So there must be some unobserved heterogeneity that's happening in 2020 that sort of, might be the nature of the shock itself, right? I mean, when you add the COVID shock, it improves a bit, but still there's a gap. So it would be nice to kind of dig a bit more on that. Yeah, and then the last comment, small comments, is understand a bit more how representative is the sample that you finally use relative to aggregate economic outcomes to see the representativeness of the results that you find. But, super relevant topic. It's a super important policy question. You have great data and great analysis. I'm looking forward to future versions and more research in this topic.
Thanks. So, Anna, do you want to respond directly? We have 2 more questions also from the audience.
Yeah, thank you very much.
Do you want to briefly give an answer, give some responses?
Yeah, thank you very much, Federico, for your comments. Some are very useful, and it's going to help us improve our paper. We have some evidence in France and in other countries that when there is a crisis, the process to exit is less, the selection into exit is less efficient. So I gave some reference in France. Some people studied the 2008 crisis and afterward, and they saw that after the great financial crisis, some firms were pushed to exit, even though they had higher productivity. They should not have. So we know that this is a risk that we have, and this is what we were looking at that. And also there is some paper by Gadi Barlevi, which I mentioned, that show that it's not only about, going bankrupt is not only about productivity, it's also about access to finance, and some good enterprise do not have access to finance, and that pushed them into bankruptcy. So this happened during the great financial crisis. We wanted that not to happen. But your question about the positive and normative analysis are well taken, and they are very interesting. Regarding our sample, we have all the firms in France. We have all of them. So it's not a sample. This is, except for a few enterprises for which we don't have all the income statement, but we use the fiscal reporting of these firms. So we have the whole universe of firms in France. We have all the bankruptcy firms. So this is not, it's not really a sample. It's the French economy, and there is maybe less than 1% of firms that we do not get. Okay, and we remove
sorry, I guess I was sort of curious about when you do the actual regression, you're conditioning, let's say, for example, in firms having debt and having all these different characteristics. At the end of the day, when you do that.
Yeah, true. Yeah, but if a firm doesn't have debt, then it's 0, and it is in the sample. We know that it doesn't have debt. Right,
but it wouldn't be in the regression. That's my question.
Oh, right. Yeah. Okay. It will be in the regression. It has with a 0.
It would appear with the 0. Okay.
Oh yeah, it would have been in the regression with the 0. So I think it's quite representative of the French economy. Regarding high frequency data, we are looking every week or every 2 other weeks. We check what's going on, which sector, where do we see bankruptcy, and so forth and so on. So we are paying very much attention to that, and of course we will use all this data later on to come up with some with some additional research, but it's a little bit early for that. Now, I see that.
Yeah,
but even
sorry, in terms of time, probably we are already over time for the first presentation. Okay.Maybe, Anna, can you just type your answer to,
okay. I think that
Q&A? I think you have the option to type your answer directly there.
Yeah, I'm going to see that because there are two interesting questions by Aye, Bade, Amadi. I'm going to answer to these two questions. Thank you very much, Federico.
Thank you.
Thanks, Anne.
For everyone.
Super interesting.
We move on to the second presentation by Angela and Martiis, and she's presenting a paper called "Are You a Zombie?" A supervised learning method to classify unviable form and identify the determinants. Yeah, over to you, Angela.
Thank you, Fang, and hello, everyone. It is a pleasure to be here and to present my paper. So the paper that I'm presenting today is a joint work with my colleagues, Thomas Heil and Franziska Peter from Zeppelin University, who are here with us. And the objective of this empirical study is to analyze non-viable companies and to understand their firm-specific characteristics. And to do this, we use machine learning methods. So why is this important? We are investigating the phenomenon of the so-called zombie companies, which is a phenomenon that remains a concern. And this is especially due to the evident rise in the share of such companies in most of the advanced economies over the last 2 decades. And this is a potential warning sign for financial regulators. And so existing studies have been investigating why this is the case. So on the one hand, the question here is, do banks keep lending to non-viable firms to avoid regulatory scrutiny? Or is this phenomenon an unintended consequence of relaxed monetary policy? It is definitely a first order issue since the global financial crisis, as we can clearly see from the picture to the left. So what are zombie companies? The term zombie firms first appeared in reference to the US savings and loans crisis of the 1980s. And with this respect, Keynes defines them as companies whose enterprise contributed capital has been lost. Afterwards, with respect to the Japanese banking crisis of the 1990s, Oshii defines them as insolvent companies with little hope of recovery, but managed to avoid failure thanks to the support coming from the banking counterparts. So this is one of the main channel investigated by the literature. More recently, Banyeje and Hoffman from the Bank of International Settlements define them as companies that are unable to cover their debt servicing costs from their current profits over an extended period of time. And just to give you a sense of the prevalence of this phenomenon, here a sentence extrapolated from an interview to the CEO of Cementir, which is one of the biggest Italian companies in the concrete business. He underlines that we have zombie kept alive by banks in the economy. So how do we contribute? So in usually existing studies investigating zombie companies, they look at the reason why these companies remain alive and on the consequences on the economy. Yet there is very little knowledge on the characteristics of zombie companies. And so the objective of our study is to find and examine those most important characteristics of zombie companies and to contrast them with those of non-zombie, distressed, healthy, and recovered zombie companies. And in order to do this, we use 2 large data sets of company financial and market data information on European and also US companies. And we use machine learning methods, specifically supervised learning methods for feature selection that allow us to select the most important characteristics of zombie companies. Among some of these methods, we use classification trees, support vector machines, but also principal component analysis, and for prediction purposes, random forest. So the goal of our paper is to better classify a company as a zombie and to develop a policy relevant prediction tool with the 15-20 most important variables that can categorize a company as a zombie and better separate them from other classes of companies. So if we can better classify a zombie company, then we can potentially better cope with the phenomenon itself. So what do we find? To give you some of the main results, what we document is that there exist differences and similarities between zombie companies in Europe and in the US on a number of firm-specific characteristics. We confirm a set of variables that matter for predicting zombie status. For example, income and leverage-related variables, and this is in line with the existing findings on Japan and Europe. And in addition, given the granular classification of machine learning methods, this allows us to show which parts of a firm's income or a firm's leverage are likely to predict the zombie status. So for example, in terms of income, what we see among others is that operating income is a recurring feature predicting the zombie status. In terms of leverage, among others, we see that long-term debt during 1 year is a recurring variable predicting the zombie status. So we find recurring variables that categorize zombie companies, but also distressed, healthy, and recovered zombie. The existing literature often labels zombie companies as financially distressed firms. And so what we wanted to understand is also whether these two types of companies, zombie and distressed, are the same, or whether zombie companies are special under certain circumstances. So we look at similarities and differences between the two, and we actually see that zombie and distress show similarities, but also often are different types of companies. We built two cross sections, so one for a crisis year, 2007, and a healthy year, 2016, and we find that the selected variables are mostly stable across time. So we do not find major differences between crisis and a healthy year. So our paper contributes to three main strands of the existing literature. The first one relates to zombie companies, and with this respect, we follow the seminal contribution of Caballero and Al and Oshii with respect to the characteristics of zombie companies. And we follow Banerjee and Hoffman 2018 and 2020 with respect to the identification strategy of zombie companies. The second strand relates to the corporate finance literature. And so we follow Altman in measuring financially distressed companies, Asquith with respect to the anatomy of financial distress, and Camben and Al with respect to the determinants of corporate failure. The third strands relate to machine learning methods for zombie prediction. Here we follow, among others, Bryman and Al with respect to the classification trees that we use for feature selection. And to the best of our knowledge, the only other paper examining using machine learning methods to predict firm failure is the one of Bargagli, Stoffi, and Al. So how do we identify zombie companies? First of all, we use firm-level data from Composite Global and Composite North America. And given this data set, so on public companies, we follow Banerjee and Hoffman 2020, and we define a zombie firm by its interest coverage ratio that has to be below 1 for at least 3 consecutive years, and its Tobin skew has to be below median within sector and year. So this is our main measure, but we also have alternative measures for robustness test. So just to give you a quick overview in terms of the prevalence of these companies worldwide, here this figure plots the share of zombie companies, and in dark blue we see those countries with the highest share. So it is clear from here that it is a widespread phenomenon and not just located to specific countries in a certain geographical area. So since we're using machine learning methods, what kind of data pre-processing are we adopting? So we use data on 32 European countries plus the United States. We build 2 cross sections, one for the year 2007 and the other one for the year 2016. And then we add also performance measures, capturing liquidity, market value, and stock market information from Thomson Reuters data stream. And so we merge all data sets and we restrict both data sets to common years and common variables only. Then we adopt usual cleaning, so meaning that we drop all variables that do not have the sufficient amount of observations, so meaning that the imputer impute only those variables with at least 85% of observations, and we impute missing values based on k nearest neighbors imputations. So this data preparation process yields us a well-stocked data set of 70 variables per company per year. So looking at the 4 classes of companies that we analyze, healthy, distressed, zombie, and recovered, what we have here is a brief selection of performance measures and median values reported that show us that zombie companies fall behind their healthy peers on a number of characteristics. We also see differences and similarities with respect to the distressed companies, and we see that recovered zombie show some growth potentials. In terms of methodology, so why do we use machine learning methods, and specifically supervised learning methods, meaning classification trees in this respect? So the high dimensions of our data renders it difficult, if not impossible, to examine the characteristics of zombie companies based on class statistical methods. Why? Well, simply because such an approach would imply to make a priori assumptions on those variables that are more conducive of the zombie status, and to rely only on a subset of the available variables. Meanwhile, using supervised learning methods like classification trees, we refrain from making any a priori assumptions, and instead we let the algorithm select for us the most important characteristics, so the most important features, classifying zombie versus non-zombie. And we rely on the most popular algorithm, so the CART algorithm, to find the best input variable and split point S. So what we have in the end is a probability function, PMK, for class K, like zombie, non-zombie, distressed, or recovered. And as a standard loss function, we use the Cros entropy. So we use the entropy simply to order the nodes in our tree, as this is a measure of the purity of the nodes. So the advantage of using such supervised learning methods like classification trees is related to their outstanding interpretability in combination with an elegant visualization and in high interpretability, because we end up with a tree-like model that looks exactly like this. So what we see here is the outcome of our binary classification tree, zombie, non-zombie, for our European country sample in the year 2016. So as in any classification tree, the white node at the top is the most important node reported, returned by the algorithm. And in our case, the variable pre-tax income is the most important variable returned by the algorithm for the first split to classify zombie companies. So from here, if pre-tax income smaller or equals to 0 is true, we follow the tree to the left. If pre-tax income smaller or equals to 0 is false, we follow the tree to the right. So with this logic in mind, with lower values of pre-tax income, the algorithm, so the tree, is likely to predict a zombie. For higher values of pre-tax income, the algorithm is likely to predict a non-zombie. However, the tree does not stop here. So if we follow the true branch, we also see the total assets, the variable AT, and long-term debt during 1 year, DD1, are also recurring features categorizing zombie companies. If we follow the false branch, we also see that for higher values of pre-tax income and non-operating income, the variable NOPI, the algorithm is likely to predict a non-zombie. And it is also important to keep in mind that the nodes with a deeper color, like a deeper orange or a deeper blue, are more pure. So this relates to the entropy. And this shows how well the explanatory variables can separate the two classes, zombie versus non-zombie. So putting our results of the classification trees all together, what we report here are the selected split variables from the classification trees, the split points, and the entropy of the nodes for zombie and distress for both the geographical areas, Europe and the US, and both cross sections. So the objective, again, is to find the most important characteristics categorizing zombie companies or distressed. And so what we see here is that looking at like colors, for example, total assets, which is a measure of the size of the company, is a recurring feature returned by the algorithm to categorize zombie companies, both in Europe and in the United States, but not distressed companies. We also find that pre-tax income is a recurring feature returned by the algorithm to categorize zombie companies in Europe and in the US, and also distressed companies. We also find that debt-related variables are also especially relevant in categorizing zombie and distress in both geographical areas, but we also find differences. For example, shareholders' equity is a relevant feature, so a relevant variable returned by the algorithm to classify distressed companies in the United States. And we find stock price return also being a recurring feature to categorize distressed companies in Europe and in the US. At the same time, retained earnings
5 minutes left.
Thank you, Fang. Retained earnings is in common to categorize both zombie and distressed in Europe. So since the objective is to find and understand the most important characteristics of the 4 classes of companies, zombie, distressed, recovered, and healthy, we also run multivariate classification trees. So the structure of the tree is the same as before for the binary trees, but now we have 4 outputs. So looking at our results, what do we find? So here, basically, we can immediately see differences and similarities, not only among the 4 classes observed, zombie, distressed, healthy, and recovered, but also between the 2 geographical areas, Europe and the United States. And again, what we see is that total assets, the measure of size, is a recurring feature selected by the algorithm to categorize zombie companies in Europe. Pre-tax income is also recurring to categorize zombie companies in the United States and also distressed companies in Europe. We again find debt-related variables as recurring features. And we also find that shareholders' equity is again confirmed to categorize distressed companies in the United States only. We also find similarities with respect to current income taxes to categorize healthy and recovered zombie in the United States. So as a validation test for our classification tree results, what we also do is we adopt support vector machine algorithms. And the objective here is to find a hyperplane in the feature space that can distinctly classify data points. And this method is effective in high dimensional spaces like ours. And so in this case, the underlying mechanism is that the bigger the vectors, the better they can separate the classes, zombie from non-zombie. So what do we find? So similarly to the classification trees, the support vector machine algorithm show us the most important characteristics classifying zombie companies in Europe in 2016 in this case. And among the most important result, what we find is a total asset, the variable AT, is especially relevant. And the interpretation of this result is that the larger total asset is, the less likely that the company is a zombie. Because again, in this case, the bigger the vectors, the better they can separate the classes, zombie, non-zombie. Among other variables also recurring and selected, we have intangible assets, depreciation and amortization, and pre-tax income, which was also recurring from the classification trees. So including all of our results from the support vector machine algorithm together for zombie, distressed, and both geographical areas, what we report here is the top input features and the weights. So the weights are similar to coefficients in linear regressions. And we see that total assets is again confirmed as a recurring variable to categorize zombie companies in Europe and in the United States. Pre-tax income is also relevant as a recurring feature to classify zombie companies. We also find, again, debt-related variables, as we saw before with respect to the classification trees. And shareholders' equity is, again, confirmed as a recurring feature categorizing distressed companies in the United States only. We also find some inventories related features specific to, for example, raw materials as important features categorizing zombie companies in Europe and in the United States, and also distressed companies in both geographical areas. So this variable is in common to both classes of companies, zombie and distressed. So to summarize and conclude, what do we do? So how do we contribute? So in this paper, the objective is to find the most important firm-specific characteristics of zombie companies, and the results confirm that there exist recurring features, there exist differences and similarities among the four classes observed, so zombie, distressed, healthy, and recovered zombie, and also between the two geographical areas, Europe and the United States. Our results support existing findings, especially with respect to income and leverage related variables, with respect to the paper of Oshii and Banerjee and Hoffman. But given the granular classification of machine learning methods, we add knowledge with additional decisive features that are able to categorize zombie companies and separate them from other classes like the distressed, the healthy, and the recovered zombie. We have a high classification accuracy between 75 and 85% for the classification trees, and between 85 and 88% for the support vector machine. So where to go from here? So next, what we're doing, given the endogeneity concerns due to the zombie definition, we're also using alternative measures of zombie. And we also believe that different legislative backgrounds, given that we're analyzing Europe and the US, could potentially explain differing characteristics across countries. And so in this case, what we're doing is we're zooming in at the country level and at the industry level. As additional also extension, we're also providing, we're also performing a deeper analysis of the class of the recovered zombie, which we think is especially relevant to better understand the phenomenon of zombie companies. And then ultimately, as I mentioned at the beginning, we want to make prediction. So we want to have those 15, 20 most important variables that can predict the zombie status. And so to do this, we're using better and stronger machine learning methods like random forest and nonlinear kernels to classify unseen samples. So thank you for your attention. I'm looking forward to the discussion and any comments. Thank you.
Thank you. Anna will be the discussant to this paper.
Okay, thank you.
Can you please share your slides?
Thank you very much, Fang. I'm going to share my slides indeed. Where are they? Okay, here they are. I have to do that. Okay. So thank you, Angela, for this talk. Everything was very clear. I think you presented some results that were not in the paper that were not in the paper. So maybe some of my comments are going to be not very useful, but still. So what does the paper do? The paper tried to identify zombie films and tell us where they are, by how much you can find, and how it evolves across time and across time. It wants to also characterize zombie films. What are their characteristics by using other information than the one that has been used to identify them. And the method to do so, they use classification trees. Okay, and it helps tell them whether the zombie films are the same in the US and in the EU, and whether it changes across time. And then the third thing they look at, they try to look at the question of, is it the case that zombie firms are different from financially distressed firms? Okay, and again, here they use multi-classification trees and logit models. And Angela didn't talk about that, but this is in the paper. Okay, so I think Angela, you show this. We saw already this thing. Okay, this is in the rest of the world. This is in Europe from 1996 to 2019, and especially since the first the great financial crisis, there is a huge increase in the number of zombie firms in the economy. In the rest of the world, it's almost 14%, and the same in Europe. Okay, so these are huge numbers. Okay. My question is the following: by reading the paper, I was no longer sure whether zombie firms are a problem. Okay, notably, it is written, we document that zombie firms are company with, I cannot read everything that I wrote, but that they are likely to recover. So my question is, if they are likely to recover, what's the point of trying to identify who they are? Because if they recover, then maybe it's not a real problem to have zombies in the economy. However, at the same time, in many occurrences, in the paper, zombie firms are also labeled non-viable firms. And they say that the paper is about detecting non-viable firms. Okay, so I think there is here a need for clarification, because either zombie firms are recovering in mass and being a zombie is not a problem, or they are not. And then you can call them non-viable firms, but it has to be made clearer, because from your numbers, I'm not sure being a zombie is a problem. Okay, so I was I'm quite impressed by this graph. Okay, and it puzzles me a little bit. If we want to explain what a zombie is, we need to understand why is it the case that since the early 2006, 2007, there is this huge increase in zombies. So if we take your definition, okay, you are a zombie. I'm sorry. If you have a interest coverage ratio less than 1 for 3 consecutive years and a low Tobin skew compared to the average of your sectors. Okay. So what happened between 2007 after 2007? Is it the case that interest payment went up because interest rate went up, or corporate debt went up? I don't know. I know that interest rate didn't go up. Maybe corporate debt went up, but not 5 times as much as it was before. And plus, because we know that interest rate went down, how come? So I don't believe that interest payment went up. So maybe this is earning before interest and tax that went down. So either because of low sales or because of tax optimization. And I have a problem with tax optimization, and I'm going to come back to that. Or it's just a consequence, this huge increase in zombie firms, it's just a consequence of more and more heterogeneity between firms. On average, firms are not doing that bad, but there are some firms that are doing very well, and a lot of firms, up to 15% almost, that are doing really badly. Okay? So we need to know what happened, okay? Because this is so striking that we cannot say, okay, I'm going to say who is a zombie, who is not a zombie, and apply the same method in 2007 and in 2018 without knowing what happened in between. Now back to the tax optimization. Okay, so this is the United States, and we have the share of zombie firm by state in the United States, and here you have you have the Delaware, and Delaware in the middle of this on the east coast of the United States. Delaware has a very low rate of zombies, and at the same time we know that Delaware is attracting a lot of companies because it's almost a tax haven within the United States, without all the drawback of having being in a tax haven outside of the United States. And maybe this is why they don't have a zombie. When you do the regression in 2006, you see that actually being a zombie decrease a lot if you are in the lower. This is significant. Okay, so my guess is that this zombification part, at least part of this zombification, might be more heterogeneity between firms, but it might also reflect something different that you have in some instance. You need to have negative profits, very low earnings before interest and taxes. So you don't pay taxes and you are going to declare positive earnings somewhere else. So I think this is something that should be looked at, because I don't, and I think the tax optimization probably went up over the period you are looking at. Okay, then I have another question. It's about the difference between zombie firms and financially distressed firms. In table page 8, the table we show, it looks as if zombie firms are those with negative earning before income and tax. The median is usually negative, and this is not what we are looking for. For me, a zombie firm is not a firm that has a negative income, but has an income that is not enough to pay its interest rate. Okay. This is why I'm a little bit concerned with this tax optimization possibility, because all these firms with negative earning before interest, EBIT, I think it's strange. Okay. Now, there is another question I had while reading the paper. It must be the case, if you have all these firms that are zombie with negative earning before interest and tax, these firms must also be financially distressed. So they must be at the same time financially distressed and zombie. So what do you do with this kind of firms? Where do you classify them? Even before doing your applying your methodology. We don't know much about the way you compute the Z-score to detect who is financially distressed or not. Then you use the 181 limit, which is something that you can find in the initial paper by Altman. But it's not like a physics constant or even a statistic coming from a specific distribution. We have to be convinced that the 181 is the good limit. Okay, and then you say zombie and distressed firms are not comparable types of companies. They are rather companies at different stages of their financial unviability. So I have to question if they are so. Which stage comes first? I'm not sure whether this is financially distressed and zombie, or zombie and financially distressed. This is something that should be made clearer. And if these are companies at the same stage, well, they are definitely comparable. So I was a little bit puzzled by when I was reading your paper. Okay, I'm going to be short on the methodology. I'm not. The first thing is I'm not sure to understand if and how the explanatory variable have been scaled in the classification tree. It looks like they have not been scaled, which means that if you look at total assets, this is total assets. So big firms are not going to be zombie, small ones are more likely to be. But is it what we are looking for? I'm not sure. Okay. Same. I mean, I was surprised, or even revenues or sales. I don't think it's scaled by the size of the total asset or something. So I was a little bit puzzled how you have all these unscaled explanatory variables. Maybe you are just catching something that is the size of the companies. Okay. Okay, I'm going to jump to the last point. It would be nice also to have some statistics regarding the ability of the algorithms to categorize the firms into the right category. So when you do logic models, maybe it would be nice to have OROC statistic, and I guess the same type of accuracy statistic. I'm not familiar with decision tree, but they must exist, and it will help to understand what you are doing. So if I want to do the bottom line, this is an interesting paper, but we want to know more about who was this firm and what's going on exactly here. Thank you for your attention.
Yeah, thanks, and for this thoughtful discussion. I Angela, do you want to respond quickly? We have also two interesting questions in the Q&A.
Yeah, definitely. So thank you, Fang, and thank you, Anne, for the discussion and the comments provided. So let me clarify some points. So first of all, what is the objective of our paper? So what we're doing, we are finding, finding the most important characteristics, categorizing zombie companies and separating them from other classes of companies, the non-zombie, the distressed, the healthy, and the recovered. So this is the objective of the paper. And in order to do this, to select the most important characteristics, we use supervised learning methods, simply because we have so many variables. And so instead of making any a priori prediction, any a priori assumptions, we let the algorithm decide for us the most important characteristics, categorizing zombie and separating them from other classes. So you were asking why so many zombie firms since 2008. So this is an excellent question, but it is, however, outside of the scope of the paper, in the sense, again, what we're trying to do in this empirical study is to find the most important characteristics. Because if we can better categorize a zombie, then potentially we can also better cope with the phenomenon itself. In terms of tax optimization, this is an excellent point. And so you're making the example of Delaware as a tax haven. So what we do see from our classification tree algorithm is that actually current income taxes and other tax-specific features are selected by the algorithm to categorize and also separate healthy companies from recovered zombie in the United States. So actually, we do see some taxes-related features, but we could maybe investigate more into that direction. So then to clarify, how do we measure, so how do we identify zombie companies? So we follow the identification strategy of Banerjee and Hoffman 2020, since we have information on public companies only. And so this means that a company is a zombie if its interest coverage ratio is below 1 for at least 3 consecutive years, and its Tobin skew is below median within sector and year. Meanwhile, distressed companies are measured with the Z-score, the Altman Z-score measure. So this is the difference between the two measures. And for the zombie firms, we also adopt alternative measures as robustness. And then with respect to the other question on the scaled of the variables. So all variables are definitely scaled, and they're scaled to total assets. So this gives us a better interpretation of the results. And so all companies are at the same level. So everything is scaled to total assets. And I think that these are the main comments. So thank you again. I really appreciate. I'm not sure if there are other comments from the chat.
Yeah, there are 3 questions posed so far. The first one is about is asked by the audience saying, based on your work, do you have any prior about the prevalence of zombies in Europe and US along privately held firms? So I understand your sample is the public firms.
So this is an excellent question. So thank you. So what we do have is we use Composite Global and Composite North America. So we have information on publicly traded companies. So it means that we are underestimating the severity of the phenomenon because we do not have information on private companies, at least for now.
Yeah. Another 2 questions about interpretation of the factors that you identified, different factors between US and the Europe. Yeah, if you can explain them. The second question is about if those factor time changing. Have you repeat this analysis over years? So do you have a quick
Sure. Okay. So with
that.
respect to the first question in terms of interpretation of the different factors, so what we do is in order to interpret the most important variables selected by the algorithm. So what we do, we also look at the existing finance literature and economic theory, because what we want to do is we want to, on top of classifying zombie companies, we also want to compare them with other classes of companies like the distressed, the healthy peers, the recovered zombie, and the non-zombie. So definitely the different regulatory measures and also bankruptcy features potentially play a role in explaining differences across countries. So what we're doing at the moment, we're zooming in at country level, and more specifically, we're trying to examine industry level characteristics, because what we also see from the classification tree algorithm is that some industries are also returned by the algorithm to categorize zombie companies in Europe and in the US. And so we're kind of going deeper into this this industry level classification in order to better understand if this could explain different regulatory factors or differences in credit markets with respect to firm success. And then the second question, I think, relates to, have you looked at how the model findings shift over the years? So what we're doing at the moment, so we're building two cross sections. So one for what we call a crisis year, 2007, and the other one, what we call a healthy year, 2016. But we haven't tried to look for other years. No, this is something that we're not doing. And do the characteristics of zombie for very pre and post pandemic. So this is something that unfortunately we cannot see, because our data set is from 1996 to 2018. So we do not have yet the years related to the current pandemic.
Okay,
thank you. I hope I answered all the questions.
Yeah, thank you very much, Angela. And let's move to the last presentation today. Federico will present the paper Distribution of Crisis Credit and Firm Indebtedness. He's from Central Bank of Chile.
Great, thanks. Thanks, Fang. Thanks for having our paper in the program, and thanks everyone who's joining today. So I'm going to talk about distribution of crisis credit and firm indebtedness. This is joint work with Joy Kowalski, Mauricio Larraín, Sergio Schmuckler, and Mario Vera. Given my affiliation to the central bank and affiliation of Mauricio to the financial regulator of Chile and Sergio to the World Bank, the usual disclaimer applies that the views and opinions expressed are those of the authors and not necessarily represent these institutions. So the motivation for this project is that during crisis, governments often seek to help firms by providing debt or equity financing. So we call this type of financing crisis credit. For example, these are credit facilities during crisis implemented to the banking sector to reach speed and scope. These policies can save firms, but also increase overall indebtedness of the private sector. And high indebtedness in turn can reduce repayment, create debt overhang issues, and influence macro recovery and create problems in the recovery. So thus, how debt is distributed across firms is critical. So the goal of this project is to study the distribution of crisis credit across firms and its impact on indebtedness. In particular, study how policy incentives can influence credit allocation and thus the distribution of credit risk. And we'll focus in particular on the policy on the large public credit guarantee program called FOGAPE that was implemented in Chile during the COVID crisis, which amounted to around 4% of GDP. So it's a fairly large program. And we will compare this program with an alternative program that also happened during the 2020, which is an employment protection program. So given this, let me tell you a bit about what I'll do. I'm going to talk about the data, then I'm going to describe a bit the policy response to the crisis to set some context. Then I'm going to study which firms obtain credit guarantees, so the selection into the program. then which firms that use this credit guarantee and how that affected firm indebtedness. And then finally, I'll go from this micro analysis to aggregate consequences of the credit guarantee program, and then I'll conclude. Okay, so in terms of the data, we're going to use 4 sources. The sort of more novel source of data we'll use is the application and approvals of credit guarantee program of 2020. So this is a new database that was commissioned for this program in particular. And for here, we have the transaction level information of these credits, including the requested and the approval amount. So we have a direct measure of both the demand side and the supply side of this program. Second, we use a firm level employment protection program that comes from the Unemployment Insurance Administrator that's going to give us information of which firms use this program. Third, we have the credit stock and flows from the financial regulators. So this is the universe, this is the credit registry in Chile. So we have transaction level, credit flows, credit stock, interest rate, default behavior, and so on. Fourth, we have the firm level tax balance sheet and employment data. So we're going to be merging financial and real data. And from the tax data, we're going to get, you know, the usual variables: total sales, material, total assets and liabilities, number of workers, the main sector, and the main headquarter municipality of the firm. So in terms of samples, we're going to be working with a baseline sample that's going to be sort of our universe of sample, a universe of firms, if you want. So we're going to have formal firms that have positive sales and positive employment. We're going to condition on this. And then we're going to have the eligible sample, which is going to be the baseline, plus the 2 constraints of eligibility for the credit program, which is a certain size in terms of sales, and also past due days less than 30 days. So that's going to give us roughly 180,000 firms for both samples. So in terms of the policy response to the crisis, we have this public credit guarantee program that expanded a typical credit guarantee program. There was a fiscal injection of about 3 billion, which amounts to around 1% of GDP. The goal was to finance working capital up to 3 months of pre-pandemic sales. That's the max amount they could get, the firms could get. You had to be sufficiently small firms, but still these are fairly large firms in Chile. Usually this program was for smaller firms, but it was expanded to allow for more medium, large firms to participate. It has attractive conditions for firms. So the loan could not be used to repay a pre-existing debt. So the pre-existing debt had to be restructured. There was a nominal interest rate cut, which was equal to the monetary policy rate plus the inflation target, so around 3.5 nominal interest rate. There was a 6 month grace period and a payment horizon of 24 to 48 months. And so to mitigate risk of this program, firms that were sort of the most risky firms in the economy were sort of excluded from the program because you had to have less than 30 days of past due. And then there was this credit guarantee, right, which is the main ingredient of the policy, which is 85% for small firms, and it goes down to 60% for large firms. And then there's a deductible that the bank has to pay. It was starting to cover sort of the risk of the firm. And this started at the end of March in 2020. And then on the other hand, we have the employment protection program that the idea here is to use the unemployment insurance funds to alleviate firms' cash flow while protecting labor contracts. The labor contracts were temporarily frozen if a worker stayed at home without working, and therefore the firms would receive the support, the cash flow support. And then the worker earnings would be paid by the unemployment insurance fund up to a 70% of earnings. So firms only had to pay social contributions, which amounted to around 20% of earnings. So it was a big help for firms. Every firm was eligible, and to support the funds, the government also injected a sizable amount, around 0.8% of GDP. And obviously there was an opportunity cost for using the program, given this design, which is in order to get the money, the workers had to stay at home without working and therefore not producing. And the program started a couple of weeks before then the credit guarantee program. So in terms of the reach of these programs, these were fairly large programs as I mentioned earlier, but in terms of liquidity provision to firms, the public credit guarantee program was significantly larger than the employment protection program. So these are measures of how much liquidity firms actually receive from these programs relative to credit stock or relative to GDP. They were fairly large. And in terms of the fraction of firms that received the program, by December, 30% of firms received either of the programs, and around 40 to 50% of firms received one or the other. So the coverage was large, and also the amount that the firms received were also relatively large. So we start the analysis by understanding which firms sort of selected into getting these credit guarantees. We do this by sort of projecting this selection into a measure of risk. And in order to measure risk, we run the credit default probability models, sort of get a predicted ex ante predicted measure of risk. And sort of what we do is run probability regressions, where the left-hand side we have a dummy of whether the firm defaulted in a previous year, say 2019, and we project that on characteristics in 2018 to understand which characteristics affect default behavior. So we project this on a set of real characteristics coming from tax data, and also financial characteristics coming from the credit registry. So you would see that the signs here, I mean, all these characteristics are important in terms of correlating with future default behavior. But let me just highlight the one that's kind of a more direct measure of risk, if you want, which is the spread, the ex ante spread of previous sort of a credit that the firms have. And here you see a positive correlation. So you can think of this risk measure as a proxy for, this defaulted risk measure as a proxy for how risk the firm is, which sort of maps into the spread that the observable spread that we have in the data. So given this model and given these characteristics, we're going to predict a measure of risk, and we're going to use that characteristic as a sufficient statistic to understand selection and effects on indebtedness of this credit guarantee program. So in particular, we're going to run this a selection model in which on the left-hand side, we're going to have a dummy whether the firm used a program, and the right-hand side, we're going to project that on a set of characteristics. So this is just for banked firms. So in the first column, you see the dummy of whether the firm used the public credit guarantee. The second is a dummy of whether the firm applied. So this is the demand side. And the third column is conditional on applying whether the firm received the program. So if you project this on risk, you can see that there's a positive relationship of risk with getting the program and with applying, but a negative correlation with getting approval of the program. So this is consistent with the idea that the most risky firms demanded more this program, but then conditional on that, banks allocated the program more into relatively less risky firms, by sort of screening firms in terms of their riskiness. If you look at the employment protection program, you don't see anything there. So there's not like a adverse selection here, but in net terms, if you combine the demand and the supply side, you get that there's adverse selection. So more risky firms applied more to this program. So, but sort of separating the demand and supply side is sort of one key contribution that we want to make, given the data that we have. And then also you see that there's a positive relationship with changes in sales during 2020, actually before the program started, sort of highlighting some nonlinearity between performance and take-up of these policies, but you don't see that nonlinearity happening with the employment protection program. It was much more likely to get the program if you had negative sales. And also there's a complementarity between the two programs. Getting one program is correlated with getting the other one. So it speaks to sort of how these programs can work together in helping firms. But then given the selection, we want to go into understanding the effect on indebtedness. So what we'll do here is that we're going to run regressions on the left-hand side. We're going to have changes of debt relative to ex ante sales. And we're going to project that on dummies of whether the firm used the program and also sales growth during the COVID crisis. And we're going to split this into firms that were banked and firms that were unbanked. So first you find that firms that took the credit guarantee program increased their leverage during 2020 significantly for both bank and unbanked firms. But then if you look at the employment protection program, you see that leverage increased, but much less. So the effect of the public credit guarantee program leverage was larger than the employment protection program. But interestingly for bank firms, using both programs actually relatively reduced leverage. So sort of this speaks also how this program can work jointly in terms of affecting financial outcomes of the firms. And again, you see this nonlinear this nonlinear relationship in the sense that firms that have positive sales and also negative sales, negative growth of sales, both increase leverage in a similar magnitude. We also confirmed this result, the increase in indebtedness, using an RD design around the sales eligibility threshold of the program. And we find that it's a significant effect of taking the program on the increase in indebtedness. But then you can sort of even make a step forward and see how this leverage is related with the ex-ante risk measure that we have. And sort of what we find is that if you look at changes of debt that were explained by this public credit guarantee program relative to sales, you see that there's a positive relationship with risk. So firms that were more risky were the ones that increased more this debt relative to sales, both for banked and unbanked firms. But if you look at debt that was non-guaranteed, so just regular debt, it's actually negatively correlated. So it's sort of telling you that maybe on the supply side, banks were more active in screening firms of regular credit than screening firms of the public credit guarantee program, maybe because of the design of the public credit guarantee program that implied that some of the risk involved was absorbed by the government. So we have all this micro evidence, but we want to sort of jump into also the aggregate consequences. So we're going to do two main analyses here. First, we're going to decompose the macro debt to GDP ratio into the micro heterogeneity that we have in the data. So first, let me give you the aggregate numbers. So debt to GDP increased from 2019 to 2020 by 3.4 percentage points. So what we'll do is that we're going to take this macro change on the left-hand side of this equation, and we're going to decompose it into group changes. So we're going to see how different groups contribute to this aggregate increase. So here you see the result. In panel A, you can see that the firms that use the public credit guarantee program increased their leverage by 4.2 percentage points, whereas the ones that didn't take the program actually reduced their indebtedness. If you sum these two numbers, that's going to give you the 3.4 we have here. If you split into status of whether the firm was banked or unbanked, you can see that the majority of the increase in leverage was driven by firms that stayed banked, whereas the firms that became banked, because this program sort of expanded to sort of new firms that didn't have a credit relationship in the past, they also contribute to the increase in the leverage, but significantly less. And then on the other hand, if you open this up across risk groups, you see that actually there's a negative correlation between level of the ex-ante risk and increase of indebtedness. So you might find this puzzling given our previous results, but let me tell you that this decomposition sort of masks two things. On the one hand, you have the weight, so how important this group is in terms of value added with respect to the economy, and the actual change of leverage. So we're going to decompose that in the next slide. We're going to just take the same decomposition.
5 minutes, please.
Yeah. We're gonna decompose this into the role that the weights play and the role that the micro changes play. So here, what's sort of interesting is that if you go to the composition of the status of banked and unbanked firms, you can see that although the firms that stayed banked increased their leverage by 3.9 percentage points, they weight around 80% of value added. So therefore, they amount to 3.1 percentage points of the aggregate. Whereas firms that are newly banked, these firms actually increase leverage quite a bit, so 30 percentage points. But it turns out that these firms are not really large in terms of value added, and therefore they contribute very little to the aggregate. Whereas if you go to this classification across risk, you do see now with the micro changes that the increase of leverage actually is increasing in risk. It's just that the weights are decreasing in risk. So the low risk firms, they amount for around 60% of the economy, and therefore if you sort of take into account the micro changes and the weights, it turns out that in the aggregate, the weights are the ones that dominate, so that you have a negative relationship in equilibrium between risk and indebtedness. And let me sort of highlight that this decomposition is sort of leveraging a lot the micro data that we have, because here we're combining the real data with the financial data at the micro level and mapping the micro level with the macro movements that we see. Okay, let me finish with this risk allocation. So remember that this is a public credit guarantee program. So part of the risk is absorbed by the government, right? So here in the first column, we have the nominal guarantee across size of firms, the ones that I mentioned at the beginning. The second column is the deductible. So the banks have to cover a chunk of the risk at the beginning. The third column is the total amount received by size. So it amounts to around 4% of GDP. The fourth column is the default probability that tells you sort of the predicted default probability that we got from our model. And the five is the effective guarantee once you take into account the deductible. And sort of you can see that the effective guarantee is significantly smaller if you take these default probabilities into account, which are sort of the average predicted ones. And given these numbers, you get that the total risk of the economy, which is basically multiplying the column 3 and 4, is around 0.2 points of GDP. So it's a relatively small number given that the program was large, but you know, the majority of the risk is taken by the bank. And this is happening because you know, the effective guarantee is effectively small. And this is because of the default probability. But the interesting thing about this program is that the program is sort of also aimed at giving more guarantee if there's tail risk behavior. So if the default probability ends up being very large, say 30% or something like that, because this crisis is special, then the guarantee, the effective guarantee, is going to be actually large. And in that case, the government might be absorbing relatively more risk than if the default probability is the same one as it has been historically. Okay, but let me sort of give my final conclusions. So on the micro side, the credit guarantee program reached a large fraction of firms, many of them in need of finance. On the firm side, there's a strong and robust adverse selection from demand forces that sort of is not able to counteract the supply forces that were screening. And firms' incentive for the credit guarantee was to get access to low-cost credit. And on the bank side, which was the role, well, it was screening of credit guarantees towards lower risk firms, as I showed, but not enough to prevent adverse selection. They allocated non-guaranteed credit towards lower risk firm, and they shared the risk with the government. And the banks, what was the incentives? Well, keep clients, but also get to know new clients at a low risk. And we think that these results are consistent with the program goals. So this is the speech of the president saying, the success of the program requires the active and expedited participation of banks so that these credits reach firms in need effectively, massively, and on time. And then on the other hand, the employment protection program, it has different behavior with respect to selection and also indebtedness, mostly because the incentives were different relative to the credit guarantees. And on the macro side, although the program increased indebtedness, the macroeconomic risk seems low. The guarantee program had several mitigating ingredients, both in the design and in incentives, so that large aggregate bank risk is low because of this low ex-ante default rate. But again, tail risk might change this. And there's also low aggregate government risk given by this low ex-ante default and also by the expected risk shared with. But these aggregate results are consistent with the financial stability reports that has been studied by the central bank. But this is preliminary in the sense that the crisis is still not over. We need to monitor this risk as the recovery moves forward. The success of the program depends on long-run effective default rate associated with the COVID crisis. And this is a function of how transitory the crisis is, health dynamics, and other economic policies. And let me just finish with one remark about the credit guarantee program in general and how we can think about this going forward, and especially its relationship with unbanked firms. We see here that there's a key trade-off between financial inclusion of firms that don't have access to it and also and compared with aggregate risk, because these firms that don't have access are going to provide more risk potentially to the system if they get access to finance. But these credit guarantee programs can be a useful policy to think about these trade-offs go forward even after the COVID crisis. Thanks a lot for your time, and I'm looking forward to the discussion.
Thanks. So Angela will discuss this paper.
Yes, so thank you, Fang, and thank you, Federico. This is a very interesting paper, and I'm very happy to discuss it. So the distribution of crisis credit and firm indebtedness. So let me start with the motivation of the paper. So this is a highly relevant, policy relevant paper. And with the COVID-19 pandemic, this has given rise to unprecedented support to companies, both by governments and central banks. And in Chile, which is the main topic of this paper, is this support has taken the form of a public credit guarantee program from the government. And so the main idea here is of the authors is to understand how credit is distributed across different firms. This is crucial. And so the goal is to examine the distribution of this crisis credit and its impact on firm indebtedness. And in order to do this, the authors exploit this large public credit guarantee program initiated by the government following the COVID-19 pandemic. It's called FOGAPE. And they look at both channels. So they look at the credit demand and the credit supply. So credit demand means program application, so those companies applying to the program, and credit supply, program approval, meaning on the bank side, so banks approving the program. And then they also compare this with the Employment Protection Program, which is another program which was put into place during the COVID-19 pandemic, again, to help companies whose employees were temporarily not working or out of work. The authors, so this paper uses novel granular data. So they have granular confidential bank information. They have transaction level data, loan applications, administrative tax records, and workers' information. So what do they find? What are the main results? So the first one relates to the fact that the big expansion of credit when the government scheme was implemented saw also the credit flowing to small and medium-sized enterprises, meaning that before the program was launched, credit was expanded only to mega companies, so those companies above $40 million. But after the government started the program, the credit flowed also to small companies. So this is one of the main results. The second result is that they provide evidence of adverse selection in companies that applied and received the credit, meaning that of those eligible companies, riskier companies were more likely to apply for the guaranteed loans. And these companies had higher pre-existing debt, higher interest rate, lower net worth, and higher default pre-crisis. And they also find that banks approved almost 95% of applications, but lent less to risky companies. The third result is related to firm indebtedness, which they find that increased substantially due to access to the public credit guarantee program. So what they find is that overall leverage increased among firms, and it increased disproportionately among risky companies and companies that borrow under this government support scheme. Now, let me move to the comments. So my first comment relates to credit flows. So the paper contributes to the literature that studies credit flows from financial intermediaries, meaning banks, to companies during crisis. And my main question here is, which mechanism is at play? So the existing research shows that banks have incentives to expand lending to weak borrowers during crisis, right? This is what, for example, Caballero and al. And Peak and Rosengreen are highlighting in these two contributions. And the paper shows that credit flowed to small companies to roll over existing debt, but also as an additional debt. So what is the mechanism at play? So why banks lend to non-viable firms? There are two answers to this question. On the dark side, banks may lend to this type of companies to evergreen, meaning to roll over the existing loans. Why they do this? Because they want to avoid recognizing the losses on their balance sheet. On the bright side, banks lend to such companies to preserve valuable relationship. So again, what is the mechanism at play in your scenario? Can we learn more on this? So maybe given again your granular data, perhaps you could examine the characteristics of these banks. Are those weakly capitalized banks? Because what Caballero and Peak and Rosengren are showing is that are mostly undercapitalized banks that have the incentives to expand lending to such borrowers. Are these smaller banks? This is what, for example, Albertazzi and Marchetti find, is they do find this evergreening of existing loans, but mostly among smaller banks. And for example, Bolton and Al, what they find is that companies that rely on relationship banks are less likely to default on their loans and are better able to withstand a crisis thanks to the favorable continuation of the lending terms. So which mechanism in your scenario is at play? I think that this would add value to understanding why banks are lending to this type of companies. Because you show that it could be because of the rollover of existing debt, but also as additional debt. So I think that this would be crucial in better understanding the mechanism with respect to the credit flows. So to my second comment relates to which types of companies obtain public help. So you're measuring risk. So, and then as a measure of risk, you compute this default dummy. And this is constructed basically to examine the characteristics of these companies that obtain the loan from this government support scheme. And what the paper suggests is that banks screen companies so that only those with less default probability would take the policy. So my question here is, but what kind of companies are we talking about? And comment 2 is related to comment 1, because I mean, we are observing the COVID-19 pandemic. So this means that the nature of this crisis indicates that many companies that would normally categorize as non-viable are instead viable, but with temporary liquidity squeeze. So can we learn whether they are illiquid but viable, zombie or dying companies? Because for example, the paper of Nurmi and Al analyzing subsidies, credit subsidies from a government program shows that zombie and recovered companies are those most frequently receiving the subsidies, the subsidized credit. And so what this indicates is that there are companies that are basically on life support for a prolonged period of time because they keep receiving this subsidized credit. And then the question here is the allocation done of credit from banks to companies done at the expenses of industry level performance and of the more efficient companies? So this is what Ottaviano and Koski and Pajmir are showing in their papers. And I think that another relevant point, again, given the very granular data that you have on banks, on companies, transaction level data. So I was wondering if you could consider the variation in scheme usage by sector. And then are these, if you can do this, are these high capital intensive or are these low capital intensive? Because for example, this recent paper of Hurley and Al on UK companies, what they show is that younger companies are those least likely to have used these government support scheme. And that companies with an established bank relationship are instead more likely to use the program. And so basically what they show is that in the end, such government support schemes, they have mostly helped small, relatively old and sophisticated labor intensive businesses in sectors that of course were most vulnerable during the pandemic. So I was wondering if you could also consider maybe shedding more light also on this. And then to conclude, so this is a very interesting paper. I really enjoyed reading it. It's a highly policy relevant topic. The authors use novel and comprehensive data on banks, companies and their relationships. The results are complemented with many robustness tests for causality. The mechanism, however, at play to explain how the credit flows from banks to firms, and also the types of companies using and obtaining this support, could be, given the data, examined further. And then I have a minor comment, but it's mostly a discussion. What should we expect when exiting a credit guarantee scheme? So, for example, Gobi and Al, they argue that the start of government support schemes increases the collateral value of a loan. And this means that encourages bank lending. So when these support schemes are ended, are removed, should we instead expect an encouragement of loan foreclosures? So I was wondering if maybe you can also add on this, given again the very granular data that you have when this program would be ended and removed, is if we should expect loan foreclosures or not. Thank you, and I really enjoyed reading the paper.
Thank you very much for this very thoughtful, extensive discussion. So since we don't have any question from the audience, so Federico, you can take the last 5 minutes to respond to the discussion.
Great, thanks. Thanks, Angela. Those comments were great. We have to think more carefully about these things that you mentioned. They are all great points. But let me try to give some real-time reactions. So first on the mechanisms, I think it's a super relevant point. We haven't gone into the details of this, but I can add a couple of things of the data that didn't have time to show. The first is that if you look at the solvency of the banking system, you see that the banking system actually increased the solvency during this crisis. And this was driven in part by some provisions that the banks had to take into account in their capital structure, but also some things about the design of the policy that allowed banks to reclassify the risk of the assets that they had. So in that sense, sort of the incentives for sort of this sort of evergreening incentives, I think might be sort of muted because of that. But this is something that we can definitely sort of take more into account in more detail. I think the sort of the fact there is that the solvency of the banking system increased, and also if you look at specific banks, I mean the banking system of Chile is super concentrated. It's like 7%, 7 banks account for like 90% of the credit stock. So if you look at these banks, this is a fact that happened in all of these banks. So I think maybe those incentives were not really strong in this context, but this is something we can think more in detail to see whether there's something going on there. And then in terms of preserving relationships, I think there's definitely something onto that. I didn't show this, but if you actually look at sort of this dummy of whether there's a pre-existing relationship between the bank and the firm, that's a super strong predictor of whether the firm will get the credit from the bank. So that's definitely something that could be going on. Banks, as I said at the end, banks wanted to keep their clients, right? And they were able to sort of restructure the debt with those firms. And also at the same time, they wanted to meet new clients, to sort of include new clients into their portfolios. And I think there's sort of a third potential mechanism that has to do precisely with the design of the policy, right? Which is, you know, the government is going to take some of this risk that the bank is taking when they accept a new client, and therefore the bank, you know, can use the sort of favorable conditions of the credit for the firms in order to get riskier firms into their portfolio without absorbing the full risk of doing that. So I think sort of the design of the policy is aimed at, and that's what I said at the end. You know, like these results are not surprising given the design of the policy, in the sense that more risky firms receive more money, because, you know, it was sort of a bit sort of intended to do that due to the incentives that the program has. Then on the second comment, yeah, I think we haven't thought really about this classification of, you know, zombie firms, liquidity stressed but viable. I think it's a useful exercise. Note though that this measure of risk is already going to be capturing some of this, right? Because we measured that smaller firms were more risky, less productive firms were more risky, lower net worth firms were more risky, and so on. So you can already infer from that which type of firms were the ones that sort of were driving these results. But I think we can do a better job in connecting with sort of the other measures that the literature has built in terms of classifying different types of firms and how they behave financially. I think that's useful. In terms of the industry versus firms, yeah, I didn't say much about this, but it was something hidden in the results. All these results have industry fixed effects, so they sort of take into account the heterogeneity across industries. But surprisingly, the industry fixed effect don't explain much of the variation. This is something surprising, given that the nature of the shock is kind of industry specific in some sense. Turns out that when you take that into the data, it just doesn't explain so much of the behavior of the demand and the supply. So the heterogeneity within the industry across firms seems to be driving what we find, and also the behavior of the policy in general. In terms of capital intensity versus labor intensity, I think the result here, this was also surprising a bit for me. The result here is that less capital intensive firms are more risky. More labor intensive firms are less risky. Yeah, it's the same thing. Okay. So that was a bit surprising for me, and this is something that we sort of found in the risk models. Yeah, I don't know if we're going to go into more details of that, but that was a finding that I think connects with your concern of what's going on with capital versus labor intensive firms. And then in terms of the final the exiting the program, I think that's a super good point. I think this is something we will be able to do, and I think it's a great suggestion. It might be a paper in itself. So I think I'm looking forward to sort of seeing what happens once this program is over. There might be some state dependence here. It might be that the program lasts for a bit longer, given that it was successful in providing funds for firms. So it's like whether the program survives or not is also a function of the success of the program. So it might be that it's going to be hard to do a causal statement about the effect of exiting the program, but I think it's super interesting, and it's definitely something we can do and should do in the future. But thanks a lot. These are super good comments. We need to think more about these issues, and it's going to definitely help improve the paper. So thanks a lot.
Thanks to you. I really enjoyed reading the paper.
Thanks.
Thank you, everybody. Thank you, all the speakers and all the audience participating in the discussion. So you guys really make me miss the offline conference we might enjoy one day again. So hope you all enjoy the rest of the conference, and we had a really great session. Thank you very much.
Thanks,
Bye-bye.
Fang, for organizing a great session. Thanks a lot.
Thank you, Fang. Thank you, Anne and Federico. That was a great session.
Yeah, thanks, Angela. Thanks, Anne. Hope to meet you in person sometime soon.
Same here. Same here.
Yes.
I hope so. I hope so.
Bye-bye. Thank you very much.
Thank you. Bye-bye. Have a nice rest of the day. Thank you.
Take care. Bye-bye.